If you want to stop depending on a job for every dollar that enters your life, you have to understand one simple distinction. There is income that comes from your labor, and there is income that comes from assets. Most people spend their lives earning the first kind. They wake up, go to work, trade their time, collect a paycheck, pay the bills, and repeat the same cycle again. If the work stops, the paycheck stops. That is not freedom. That is a dependency structure. The goal is not to hate work. The goal is to build a system where work becomes a choice instead of a requirement. If your job pays you $80,000 a year and your life is built around spending roughly $80,000 a year, then the math is direct. You do not become financially free because you have a nice portfolio balance on a screen. You become financially free when your assets can produce enough cash flow to replace the paycheck that currently supports your life. That does not happen by accident. It does not happen because you watched one video, bought one stock, or found one magic investment that solves everything. It happens by understanding how different assets behave, what kind of income they produce, what risks they carry, and what trade-offs you are accepting when you put money into them. A lot of financial advisors tell people to put money into a broad stock market index. Keep doing it for decades and let compounding do the work. That can be a good wealth building approach. I do not dismiss it. Broad market ownership has helped many people build net worth over long periods of time. But building net worth and replacing a paycheck are not the same problem. When you are trying to replace a paycheck, you are not only thinking about the long-term value of the asset, you are thinking about cash flow, you are thinking about timing, you are thinking about stability, you are thinking about whether the income shows up when the bills show up. That is a different kind of problem, and it requires a different kind of thinking. I want to walk through 5 types of assets that can help create income from capital. I want to start with the simplest and move toward the more difficult, not because simple is always better, and not because difficult is always bad, but because each step requires more judgment, more work, and more ability to handle risk. This is not easy. It will take money, it will take sacrifice, it will take patience, and most importantly, it will take the ability to think in systems instead of emotions. People like the idea of passive income because the phrase sounds effortless, but most passive income is not truly passive at the beginning. It is usually built through active sacrifice first. You earn money, you avoid wasting too much of it, you move it into assets, and then those assets begin doing some of the work that you used to do with your own time. That is the machine you are trying to build. The simplest place to begin is lending money to the United States government through Treasury securities. When you buy a Treasury bill, Treasury note, Treasury bond, or a fund that owns short-term treasuries, you are effectively making a loan to the government. In exchange, the government pays you interest. That interest can become a stream of income. The attraction is obvious. Of all the borrowers in the financial system, the United States government is generally viewed as one of the safest dollar borrowers because it has taxing power. And because the Federal Reserve System sits behind the broader monetary structure, if the United States government could not pay its obligations, the problem would not merely be your Treasury position. The problem would be the entire global financial system. That does not mean there is no risk. It means the risk is different. One benefit of Treasury income is that it is generally exempt from state income taxes for someone living in a state with high taxes that matters. A dollar of income that avoids state tax can be more valuable than a dollar of income from an ordinary savings account that is taxed at both the federal and state level. Another benefit is that Treasury income can be arranged in a regular way. If you own a short-term Treasury fund or an ETF that distributes income monthly, that can feel closer to a paycheck than an investment that only grows on paper, but you have to understand what you are not getting. You are not usually getting meaningful growth in the principal. If you lend $100 and receive interest, the $100 itself does not become $200 because the borrower is paying you. The income is the return, the principal is mostly the base from which the income is produced. That means treasuries can help with stability and income, but they are not usually the asset that creates enormous long-term wealth by themselves. You also have the risk of lower returns. If the asset is considered safer, you should generally expect less return than you might seek in riskier assets. That is one of the most basic principles in investing. You cannot demand high returns without accepting some form of high uncertainty. There is also a distinction many people miss. A Treasury obligation is backed by the promise of the government, but it is not the same thing as an FDIC, insured bank deposit. A bank deposit and a Treasury security are different legal structures. A high-yield savings account may have deposit insurance up to the applicable limits. A Treasury security has the government's repayment promise. Those are not identical. One simple way many investors access this kind of income is through a short-term Treasury ETF, such as one that holds Treasury bills maturing in 3 months or less. At the time of the original discussion, A fund like SCUV was producing a yield around the mid 4% range and paying monthly distributions. The key is to understand the role of the asset. If the share price does not move very much, that is not a failure. That is part of the design. The income is being paid through the interest distribution. When the distribution is paid, the fund price can adjust by the amount of the payout that is normal. You are not buying it because you expect the price to explode. You are buying it because you want a relatively stable income mechanism backed by short-term government debt. But this income will move with the interest rate environment. If the Federal Reserve cuts rates, short-term Treasury yields generally decline. If rates rise, the income available from new short-term Treasury holdings can rise. So even with something that appears simple, the macro cycle still matters. That is one of the principles I use when looking at any asset. You do not judge it in isolation. You ask what environment it performs in, what environment hurts it, and what role it plays in the whole system from there. The next step up in complexity is dividend. Paying ETFs a dividend is a share of profit that a company distributes to its owners. If you own a stock and that company pays a dividend, you receive a portion of the cash being sent to shareholders. In that sense, the stock is not only something that may rise in value, it can also become an income-producing asset. The idea is attractive because the income comes from businesses that are operating in the real economy. They are selling products, earning revenue, managing costs, and distributing some of the profit. But owning one dividend stock creates concentrated risk. A company can have a great history and still run into problems. It can take on too much debt. It can lose competitiveness. It can hire weak leadership. It can face disruption. It can cut the dividend. In extreme cases, it can fail completely. When that happens, you may lose both the income and the capital value. That is the double risk of a bad dividend stock. The dividend can look attractive right up until the underlying business breaks. That is why dividend ETFs can be a simpler way to approach the income problem. Instead of owning one company, you own a basket of companies. If one company deteriorates, the fund may reduce or remove that exposure over time. You are still exposed to market risk, but you are not depending entirely on one board of directors, one balance sheet, or one competitive position. This is not risk. Free investing always carries risk. You should expect volatility. You should expect periods when the price goes down. You should expect times when income changes. Anyone who tells you that an investment gives you income without uncertainty is not explaining the full system. But compared with selecting individual companies yourself, a dividend ETF can reduce the amount of company-specific work you need to do. There are several categories to think about. One category is dividend growth or dividend quality in the United States. An ETF that focuses on dividend aristocrats, for example, owns companies in the SP 500 that have raised their dividends for at least 25 consecutive years. The attraction is not necessarily the highest yield today. The attraction is the discipline and history of companies that have continued paying and increasing cash distributions through many different environments. A fund such as Noble is built around that idea. At the time of the original discussion, it paid a little over 2% annually in dividends. That may not sound exciting if you are chasing yield. But yield is not the only variable. Reliability, dividend growth, and quality of the underlying companies matter. Another category is broader high dividend exposure in the United States. A fund like SAG gives exposure to a different group of dividend-paying companies, and at the time of the original discussion, it was paying around 4% annually. The logic is straightforward. You are trying to own many businesses that produce cash, distribute some of that cash, and continue operating without requiring you to watch each business every day. Your main job becomes earning enough money to keep adding capital to the system. There is also an international dividend category. This matters because the United States is not the only place where businesses exist, profits are made, and dividends are paid. Some companies outside the United States operate in markets that may have different growth profiles. Some countries may have faster demographic or economic growth. Some companies may pay higher dividends. Funds such as VME or IDV are examples of international dividend ETFs at the time of the original discussion. VME was paying around 4% and IDV around 5%. But again, higher income comes with different risks. International markets can involve currency risk, political risk, lower transparency in some jurisdictions, different accounting standards, and different economic cycles. A dividend paid in another currency can become more or less valuable when translated back into dollars. A country can grow fast and still be a difficult place for investors if the rules of the game are unstable. So I would not look at international dividend exposure as a magic solution. I would look at it as another tool in the system. It may diversify income sources. It may increase yield, but it must be sized and understood. Then there are real estate-related ETFs, especially REIT. ETFs or REIT is a real estate investment trust. It is a structure that allows investors to own exposure to real estate through public securities. Some REITs own physical properties such as apartments, offices, hotels, warehouses, or other real estate. Other REITs invest in mortgages and debt connected to real estate. The distinction matters. A real estate REIT is tied more directly to properties, rents, occupancy, property values, financing costs, and management quality. A mortgage REIT is tied more directly to interest rates, spreads, leverage, and the performance of mortgage assets. An ETF such as VNQ gives broad exposure to equity REITs, the companies that own properties at the time of the original discussion. It paid around 4%. A mortgage REIT ETF such as REM was paying a much higher yield, around the high single digits. It is easy to look at a 9% yield and become excited. But one of the worst mistakes investors make is choosing an investment solely because the yield is high. A high yield can be attractive. It can also be a warning sign. If the asset is weak, the price can fall, the dividend can be cut, and the investor can discover that the apparent income was not a free lunch. Income investing is not about finding the biggest number on a page. It is about understanding what produces that number, whether it is sustainable, what can cause it to fall, and whether the underlying asset is something you actually want to own. That principle matters even more when we move into the next category, which is owning real property. Real estate is powerful because it can produce income, represent a hard asset, and create tax advantages. But real estate also requires more work, more judgment, more operational ability, and more willingness to deal with problems. You can invest in real estate in different ways. You can buy a rental property yourself. You can invest in someone else's deal. You can participate in a syndication or a crowdfunding structure where you provide capital and someone else handles the operations. But if we focus on owning the property directly, the structure is easy to understand. You buy a property not to live in, but to rent out. The tenant pays rent. That rent is used to pay property taxes, insurance, maintenance, management, vacancy costs, and any financing costs. If there is debt, if the numbers are right, there is money left over every month or every year. That remaining money is the cash flow. The reason many wealthy people like real estate is not mysterious. It can produce recurring cash flow. It is a tangible asset. You can see the building, you can touch the land, you own something that serves a real human need. And the tax code can be very favorable to real estate owners when the structure is handled correctly. But every one of those benefits has a trade-off. Cash flow only exists if the numbers work. A building can look attractive and still be a bad investment if the rent is too low, the expenses are too high, the neighborhood is weak, or the repairs are underestimated. A hard asset can still lose value. Real estate is physical, but that does not make it automatically safe. A property can have bad tenants, legal issues, structural problems, insurance problems, or local market decline. Tax benefits are real, but they require proper accounting, proper documentation, and usually professional guidance. This is where most people get hurt. They fall in love with the idea of real estate before they understand the arithmetic of real estate. Suppose a property costs $200,000 and can rent for $2,000 a month. The rent sounds good, $24,000 a year of gross income sounds good, but gross income is not what you keep. You have to subtract property taxes, you have to subtract insurance, you have to subtract maintenance, a toilet will break, a roof will age, appliances will fail, you have to subtract management, even if you manage the property yourself. You should assign a value to that labor because your time is not free. You have to subtract vacancy because tenants move out and empty months happen. After those costs, suppose the property produces $10,000 a year in net operating income before financing. If you paid $200,000 in cash, that is a 5% return on the purchase price. Is that good? The answer depends on the investor, the market, the risk, the work required, and the alternatives available. For some people, 5% may be acceptable if the asset is stable, the market is strong, and there is long-term appreciation potential. For others, it may not justify the work and risk. The original discussion used a target closer to 7% cash. On cash as a more attractive threshold, that would mean wanting about $14,000 a year from the same $200,000 invested. In today's market, finding that kind of deal can be difficult, but difficult does not mean impossible. This is one of the realities about real estate. It rewards people who are willing to do the work. You may have to study more markets, you may have to look outside the expensive city where you live, you may have to analyze many properties before one makes sense, you may have to accept that most deals are not deals. The phrase that destroys people in business and investing is, How hard could it be? Real estate humbles people who say that it looks simple from the outside because everyone understands houses. But owning a rental property is not the same thing as living in a house. It is a business, it has revenue, expenses, operations, customers, legal obligations, taxes, repairs, and management decisions. If you treat it casually, it will punish you. If you treat it as a system, it can become a powerful income machine. Then there are the tax dynamics. A rental property may produce $10,000 of cash flow, but the taxable income may be lower because of depreciation. Depreciation allows the owner to deduct part of the value of the building over time because the building is considered to wear down as it ages. The land itself does not depreciate, but the building does. If a $200,000 property has $30,000 allocated to land and $170,000 allocated to the building value can create a depreciation deduction each year under the standard rules. That deduction can reduce the taxable income generated by the property. There can also be ordinary and necessary business expenses. If a cost is genuinely connected to running the real estate business, it may be deductible under the applicable rules. But this is exactly where people need a good accountant. Tax rules are powerful, but they are not something to improvise. The larger principle is this: real estate can produce income and can have tax advantages, but it is not free money. It is a more advanced asset because it requires more work, more education, more operational discipline, and more ability to evaluate numbers. From real estate, the next step is business ownership. This is where the difference between working for money and owning a system becomes very clear. An employee receives a salary for labor. The owner receives the profits after the business pays its expenses. That distinction is one of the biggest differences in capitalism. A business might generate $1 million in revenue in a year. It might have $600,000 in expenses, including salaries, software, rent, contractors, and everything else required to operate. The remaining $400,000 is profit. In a normal structure, that profit belongs to the owners. That is why ownership matters. A person can work inside a business and earn a salary. A different person can own the business and receive the profits. Sometimes those are the same person, sometimes they are not. But this is also where fantasy and reality must be separated. Owning a business can create extraordinary income. It can also destroy capital, time, and emotional energy. Starting a business is difficult. Buying a business can also be difficult. Running a business is much harder than most people imagine. The internet makes business ownership sound easy. Buy a car wash, buy a laundromat, buy a small service company, buy something boring and collect the checks. Sometimes that works, often it does not. A small business usually depends on active management. If you buy a small business and there is no strong operator in place, you may have bought a job, not an investment. You may have to become the CEO, the salesperson, the problem solver, the hiring manager, the person who handles customer complaints, the person who fixes the system when it breaks. That can be wonderful for the right person. It can be terrible for someone who wanted passive income if you want a business to be truly passive from the beginning. You usually need more money. You need a business large enough to support management, systems, employees, processes, and resilience without requiring you to be involved every day. That kind of business can require hundreds of thousands or millions of dollars of capital. If you buy a smaller business, you should expect to work in it or build it to the point where you can eventually replace yourself. That is not a problem if you understand it. It is a problem if you pretend it is passive when it is not. The same principle applies here that applies to real estate. You must know what you are buying. You must know the industry. You must know whether you are willing to do the work. You must know whether the cash flow is real or just an attractive story from the seller. You must know whether the business can survive without you. And you must understand that profit is not guaranteed simply because a business has revenue. Business ownership is one of the most powerful assets because a good business can create income, build equity value, and scale over time. But it is also one of the hardest assets because it requires judgment about people, customers, systems, operations, competition, and cash flow. If you are the kind of person who wants to learn, operate, build, and solve problems, business ownership can be a path to both wealth and meaning. If you are not willing to work, it can become an expensive mistake. The last category is private credit or peer. To peer lending, this means lending money not to the government, but to another person or business. That borrower might need money for a property, a car, a business project, a real estate flip, or some other purpose. In exchange, they pay you interest. This market can produce higher yields because the risk is higher. If someone is willing to pay 10, 15, or even 20% interest, you have to ask why. Maybe the borrower has a profitable project and needs speed. Maybe a real estate investor is doing a short-term flip and is willing to pay hard money rates because the profit margin supports it. But maybe the borrower is risky and cannot access cheaper capital for good reasons. High interest is not automatically good, it is compensation for risk. And sometimes the risk is bigger than the compensation. If I were looking at this kind of lending structure, I would want collateral. I would want to know what backs the loan. If the borrower does not pay, what can be recovered? Is there real estate behind it? Is there a lien? Is there documentation? Is the loan properly structured? What happens in default? How long does recovery take? What are the legal costs without those protections? You may simply be making an unsecured loan to someone who may or may not repay you. There are online platforms that connect lenders with borrowers, and they can make access easier. But easier access does not remove the need for due diligence. Platforms can fail, borrowers can default, collateral can be overvalued, legal processes can take time. So private lending is not something I would treat casually. It can be another stream of income from capital, but it requires understanding credit risk. In many ways, you are becoming the bank. And if you are becoming the bank, you have to think like a bank. You have to evaluate the borrower, the collateral, the interest rate, the downside, and the recovery process if things go wrong. This brings me back to the bigger point. Replacing a paycheck is not about finding one perfect asset. It is about building a system of income, producing assets that match your skills, your temperament, your capital, your time, and your risk tolerance. Treasury securities may be simple and relatively stable, but the income is limited and depends on rates. Dividend ETFs can create market-based income and diversification, but they can fall in value and the income can change. Real estate can create strong cash flow and tax advantages, but it requires work, analysis, management, and discipline. Business ownership can produce enormous income, but it is hard, operational, and often far from passive. Private credit can produce attractive interest, but the risk of default is real and must be managed carefully. Each asset is a tool. The mistake is believing the tool solves the problem by itself. The real solution is the process. Earn money, save part of it, understand your options. Buy assets intelligently, reinvest, build income streams, keep learning, avoid leverage you do not understand, avoid yield you cannot explain, avoid laziness disguised as passive income. The other mistake is thinking that financial freedom should happen quickly. If you need $80,000 a year from assets, and your assets produce 4% income, you need $2 million of productive capital. If your assets produce 5%, you need $1.6 million. If they produce 8%, you need $1 million. But higher yield usually means higher risk, more work, or more volatility. That is why the path is not just about yield. It is about building enough capital and putting it into the right mix of assets. Most people get discouraged because the number looks large, but every financial machine starts small. The first $1,000 of assets will not replace your paycheck. The first 10,000 probably will not. The first 100,000 may only produce a few $1,000s a year, but the system changes how you think. You stop seeing money only as something to spend. You begin seeing it as something that can hire more dollars to work for you. That mental shift matters. When you own assets, your money is no longer only a storage unit for past labor. It becomes a productive system for future income. That is the point of all 5 assets. They are not the same. They do not carry the same risk. They do not require the same knowledge, but each one represents a way to move from earning only by labor toward earning from ownership and lending. And that is the transition people must understand. There is nothing wrong with working. Work can create meaning, structure, identity, and purpose. But being forced to work because no assets are producing income is different from choosing to work because you want to. The goal is not to become idle. The goal is to become free enough to decide. If you are beginning, start with the assets you can understand. Do not pretend to understand something because it pays a high yield. Do not buy a rental property because someone on the internet made it sound easy. Do not buy a business because the profit number looks exciting. Do not lend money privately because the interest rate is large. Look at the system underneath. Ask where the cash flow comes from. Ask what can interrupt it. Ask what you lose if you are wrong. Ask whether you have the skill and patience to manage the asset through a difficult period. That is how you avoid being fooled by income. Because income is only valuable if it is durable enough, understandable enough, and properly sized enough to survive reality. If you build this correctly, the pattern becomes clear. Your paycheck funds your assets. Your assets produce income. That income buys more assets. Those assets produce more income. Over time, the dependency on the paycheck declines. Eventually, the asset income can become large enough that the job is no longer the central pillar of your financial life. That is the point at which choice begins. It will not be easy. It will not happen overnight. It will require sacrifice, but it is possible if you build the machine instead of chasing the shortcut. And once you understand that, you stop asking, how do I get rich quickly? You start asking a better question, what assets can I understand, own, and build patiently until my money no longer depends entirely on my labor? That is the question that changes the game.